Welcome to Face, Mike.
Yeah, glad to be here. You can hear me okay, correct?
Yeah, loud and clear. Did you want to share your screen? You have anything that you want to show?
Let's see.
Or
I
is it
can, we can chat a little bit here.
okay?
I don't mind throwing up a bond chart or talk
Okay,
a little bit about
sure.
interest rates and so on.
All right, you know how to use Zoom. There's a green share box there
I,
to
I also made you a co-host in case you want to share your camera as well. So,
Okay,
share your screen
perfect.
camera, whatever you feel
yeah, so you
comfortable
show
with.
your pandemic haircut.
Let's see.
Like mine.
Fortunately, when they first reopened the places down here, I was able to sneak a haircut in, so I'm not in too bad shape.
Okay, I am. I look like Ringo Starr. Anyway, Mike, really nice to meet you. And, I'm familiar with Dr. Martin Weiss from many years ago, around the beginning of my career. So I'm interested, before we get to the charts, on what your journey was like to get to where you are at point B. How did you break into the industry? And tell us a little bit about your background.
Sure, absolutely. I find I've been working at Weiss for a long time, since 2001, and I've found that about half the people I've worked with over the years in the investment publishing and advisory business come up from the traditional broker channel, or they're money managers, they're handling clients and so on. Then about half come up from the journalism side, and I look at it as you either know the writing and you learn the finance, or you know the finance and you learn the writing and communication. And I'm in the communication camp. I actually, when I was in Boston University in the mid 1990s, I started working for Bloomberg News, their bureau in Boston there, and that was kind of my
Cool.
first exposure to the financial markets, just writing brief stories and things like that when
Were
I
you
was
a
still in school.
journalism major at Boston U?
Yes, I was. I was an English and
Good.
journalism double major, so
Okay.
I stayed up
Okay.
there during my summers and did some extra classes and so on. So that was where I kind of got directly exposed to the market. I mean, my father, for years and years before that, had been talking about the markets. I remember him drawing hand charts in the 80s and
Oh
different
yeah.
things and so on. So,
Me
um,
too, son.
so in any event, yeah, I mean, I didn't know exactly what they were when I was 10, but it was fun to
Yeah.
look at.
Yeah.
In any event, so I
Interesting.
picked it up there, and then after I graduated, I went to work for Bankrate.com, kind of following and writing about the mortgage markets, housing industry, and so on. And then I transitioned over to Weiss again in 2001, and I've worn a lot of hats there, whether it's writing, editing, helping trade our premium or newsletter services, and so on. Done a little bit of everything there, and it's one of those things where there's always something new going on. There's always something different to talk about, and it's a business and industry that's always constantly changing, given what the markets do. So even after all these years, I still find it fascinating and do my best to help people navigate things, especially when we have years like this where it is
Yes.
truly, truly unpredictable and unforeseeable in so many ways.
Yeah. So the jigsaw puzzle. We guys like us do not have to do brain exercises to, stay alert and avoid what happens later in life. I want to ask you about a book I read that Martin Weiss wrote in the 70s. You probably, well, let's see if you heard of it. The Great Money Panic.
Yes, I have heard of it. We have actually in our building, which of course we're all working remotely right now, but we do have sort of a library, a storage room that has all of the old things that Martin's published over the years, and I have gone through them, absolutely.
Did you read that book?
I've read part of it, not the whole thing,
All right.
cover to
All right.
cover.
All right. So it's interesting. He describes in that book basically that there's so much debt that rates go up not because of economic growth, but they go up because there's not enough demand for the paper, and rolling things over creates a spike in rates, which we were beginning to see in a small way in the Fed funds market. I think about back in the fall,
hmm
and what happens then is that as rates go up, it creates a deflationary environment where people are selling everything to gain liquidity, including the kitchen sink. And I think he was talking about rates going up to 20, which they did under Volcker
hmm
after he wrote the book. And I'm curious if you think that that could ever happen with the role the Fed has been playing, especially on this last foray where they came in to support both corporate and junk bond markets, and have they taken those markets away from us as traders and investors and nationalized them? What do
Sure.
you
I mean,
think?
I have a couple thoughts on that. I think when it comes to credit sensitive markets, junk and to a lesser degree investment grade and so on, I think that those markets, we're still going to see if the fundamentals deteriorate, if the credit fundamentals deteriorate going forward, whether it's because of what's happening with COVID or this sort of dragging out of this this downturn and so on. I think that those markets can and likely will still get away from the Fed to some degree. When it comes to the government market, I've been for quite some time, a number of months, a few quarters now, really in sort of the disinflation, recession, structural, demographic camp for lower interest rates. I think that, if you look at the interest rate markets, you go back to 2018, late 2018, that's when interest rates peaked and the curve started to flatten long before anybody heard of the coronavirus. And I think a lot of it was a turn in the economic and credit cycle that began back then. You can see it in a number of different ways. I mean, that's when I call them the boring sectors, things like utilities started to outperform the exciting ones, financials lagged, curve flat, and all this stuff was going on before anybody heard of the virus. And that only kind of accelerated and amplified trends that were already in place. So barring some, huge inflationary or growth shock, if I'm underestimating the magnitude of, or if we do get this theoretical V-shaped recovery, I'm still in the lower for longer camp. And when I look at the Fed talking about, I jokingly call it NERP forever, or ZERP forever, excuse me. If we're in this environment where they're saying we're not going to raise the fund rate even if the economy gets better, and so on and so forth. I mean, last cycle, interest rates stayed pegged near zero for 7+ years or around that time. What's going to happen in this cycle where arguably the economic news is worse? Plus, we still have the aging population, the structural sort of loss of productivity, and so on. So, in that environment, I think that interest rates, if anything, at the long end especially, are going to be falling back towards zero over the next year or so.
Okay, interesting. A lot of people forget that we were already close or in a manufacturing recession prior to COVID, and that the consumer was really the engine. It usually, it's 70% of the economy, but the consumer was still doing well. After this government stimulus money that's being sent out to give people more money than they would make if they were employed, and stimulus money that, I don't know about you, I never received it, but plenty of dead people have. So I'm thinking that I'm thinking that the only way for me to get it is to will it to somebody. So
yeah, we've got dead people getting stimulus checks and zombie corporations getting Fed help. So it's kind of works all around.
All right. So we're looking at the note chart, the 10-year, right? That's what you have up here.
This is the long bond
30?
here. But,
okay. All right. So when the Fed came in, I think that was the biggest sell-off that I've seen in bonds in compressed time ever from the high.
Yeah.
And I'm wondering, we're right against, what's that blue moving average that you have right up there?
We've got the 50, and that's the 50 there here. So
okay.
50.
So if we break out over that, you think there's a shot for us to test at highs, and will that do you think that'll happen in a risk-off environment, or that these rates will continue to support equities and other asset classes?
Sure. I'm more in the sort of negative camp on risk and the economic backdrop here. I think that obviously we've had the initial big risk on move. Fed comes in, does its buying and backstopping of all these different asset classes, including junk and so on. And that, gave us a decent rally. But when you look at something like, flip from a price to a yield basis, I mean, the rally in yields off the low really was a lot more subdued than what we saw in things like equities. And now, whether we're talking about 5s or 10s, we're really kind of back to those March lows. I mean, the 5-year yield at around 31, 32 basis points That's essentially where we were at the middle of the March panic. And
Right.
you moved to 30s, we popped up to, what was it, about 175, somewhere in that neighborhood. And here we are back at 140. I think you're seeing rallies in interest rates are not anywhere near as vigorous as rallies in equities. And that, again, that was the case even pre-COVID. I mean, this being a 30-year yield chart, you can see that the peak was all the way back in November 2018. And even as the equity market was, in terms of the S&P, was making marginal new highs, you had a lot of sectors that weren't participating in sort of non-confirmations there. And clearly we saw it in the interest rate market as well. So I think I look at our interest rate environment in the U.S. and I see a lot of similarities to what already has befallen Japan and Europe and so on. And again, it's that sort of ZERP forever, and as much as the Fed might protest, maybe eventually NERP. I mean, we've seen.
Yeah, I was going to ask you if you thought we were going to go there.
What
do you think would take us there? Bear market, another 30% lower in equities. It seems like that's a major focus for the Fed and the U.S. government as far as tax receipts and confidence. You think weakness in equities would take us there?
Yeah, absolutely. Rates? I think if you look at, again, the risk sentiment has been supported by all the things the Fed did in late March and early April and so on. But really what the Fed itself will tell you it's trying to do is build a bridge. It's trying to just kind of hold things together for a few months while the underlying economy gets better, Main Street gets back to work and so on. But the problem is the longer that this COVID situation drags out, the more you have lenders kind of tightening credit behind the scenes, especially for smaller credits and so on. That is really a negative or restraining factor on growth. So if the real economic news begins to worsen, which is kind of what we're seeing again to some degree, that bridge is going to end. That bridge is going to end in the water. It's not going to get you to the other shoreline. So I think that's what we're starting to deal with in the equity markets. You're starting to see some questioning of whether this bridge is going anywhere. So if that truly accelerates to the downside, if we lose that risk on sentiment, you see spreads widen again and so on, I think people are going to say, what's the next logical step? Probably what's going to happen first before we go into NERP territory is going to be some form of yield curve control. The Fed's going to try and mirror what's happened.
They'd like to have it steepen.
Yeah, and I don't know where exactly they're going to try and peg things. I mean, we've essentially had yield curve control in the fives. I mean, the range there is only a few basis points over the last several weeks. Tens are back in that mid 65, 70 range, and 30s up again, where we talked about earlier. We've seen the Fed try and effectively or see the market kind of preemptively pricing for some form of yield curve control, in my opinion. But I think that again, they're going to have a hard time keeping the curve steeper if the economic news is worsening. I think that a lot of traders, rightfully so, are going to say, look, I can still get 140 or 130 or whatever on the long bond. I'm going to buy that, and I'm going to see if this thing heads back to new lows. Because if the growth and inflation data continues to look lousy and there's no prospect for a V-shaped recovery, then I think you buy the medium to long end of the curve, and you just stay long there for some capital gains potential.
Mike, does a currency and the dollar play a role in your analysis for where rates are going? And if you have a view, what would that be dollar-wise?
Sure. I mean, I think clearly, if you look just at the dollar index and what happened here in that March-April timeframe, I mean, the spike, the huge rally in the dollar was all part of the risk-off trade, and the Fed has successfully, up until a couple weeks ago, tamped that down. I think, I'm definitely keeping an eye on it because we've seen tentative stabilization, dollar index 96, 96 and a half, and so on. We made a higher low there. If we take out these recent, this sort of capping area that you've had here at around 97.67, 97.70, that's going to be another risk-off signal. So I think that in this situation, we're definitely going to have to keep an eye on the dollar as well. And I would also add too, if you look at, or what I find very interesting is the gold market. I mean, I'm not a traditional gold bug. I always say I'm a generalist. There's times when I like gold. There's times when I hate it. There's times when I don't really care what it's doing because there's better opportunities elsewhere. But certainly I've been bullish on gold since late half or back half of 2018, and I'm pretty encouraged with the constructive action there too. I mean, I think that's still telling you to some degree that even with equities strong, you're still getting buying of safe haven assets and some concern about what the outlook is for the economy overall. And I think the gold market is kind of telling you investors do want protection from less than optimal economic outlooks, and also from money printing. So that's another area that I think is pretty
Don't you
encouraging.
think it's a little crowded by now, Mike? And we're starting to see some negative divergences in gold up here at new highs, and the mining shares are not confirming this new high in physical gold.
That's a very interesting thing you pointed out there, and I can interpret it two ways. I mean, the people that we talk to and the people that are in the Safe Money Report newsletter and so on, I'm not really trading the very short term. It's more of an intermediate to long term type environment that I'm looking for. So I think in the short term, yes, you have some issues with gold and so on. But when I think about, okay, what's the potential for more upside in gold equities, whether it's juniors or senior miners and so on, I mean, the metal itself has looked a little bit stronger and is much closer, I think, to its old highs than many of the mining shares. And I think that if you just turn on CNBC, I mean, you hear about technology stocks 100 times an hour. Are they really talking about gold? Is Main Street all in, so to speak, on gold miners the way they might have been back in 2010, 2011? I don't pick up on that. So I think there's probably, if anything, some catch up coming in terms of, if Main Street, if more money moves from Apple to Newmont or what have you, and you see people realize what's going on there and the potential, I think that is what might lead to kind of a blow off or late term move, but I don't think we're there yet.
Okay, yeah. So the market capitalization of all the gold miners is probably equal to Amazon, or not, or a tenth of Amazon, right?
Yeah,
It wouldn't take a lot of money flow.
A lot of times people just want to talk about, I jokingly call them the S&P 5, because they're ignoring the other 495 or so stocks. It's all about Amazon and Facebook and Apple and and so on. But a lot of those other, if even a portion of that money starts looking at the returns you've seen in miners and say, hey, maybe this is something to be interested in, that's going to be an interesting next leg up for this, in my opinion.
Okay, I'd like to switch gears to what else rates are very important in, and that would be the real estate market. And I'd like to start with, did you think in 2009, after the housing crisis and the Great Recession, I don't know if it was great for you, that we would see values take out the highs, not throughout the country, but definitely in certain markets, we surpassed the 2008 bubble highs. Did you think that was possible? And what's your view on real estate with what's going on here and a lot of people going to programs to not have to pay their mortgages for a while, forbearance? What's your view on really probably the most important investment most people have in this country?
Sure. I mean, coming out of the housing downturn, we were heading into it, we were very aggressive in warning about it. I mean, given my background in mortgages and real estate and just following the interest rate markets pretty closely, I mean, I saw, and for that matter, living down here in South Florida, where the mania was, as bad, if not worse than what you saw in places like Las Vegas and so on. It really gave you a firsthand window into what was going on. And after, I want to say maybe circa 2010, you had the huge rally, you had the crash. I sort of internally, I kind of was talking with people. I said, I think the real estate market's just going to move off the front pages. It's going to be sitting there. It's not going to be very exciting. Nobody's going to be flipping houses anymore. It's just going to go back to what it always was you can buy a house to put a roof over your head. Then I think what started to happen a couple of years later is we saw, as a result of the QE programs and everything else, domestically and abroad, we saw enormous amounts of asset inflation, generalized asset inflation. Housing is obviously part of it. A lot of homes were snapped up by big funds to turn around and use them as rentals. A lot of money was going in on almost an institutional money coming in to buy to rent and generate income from that. But we saw commercial real estate values soaring. We saw obviously stocks and the higher risk bonds and so on. And even I pulled a lot of examples for a book I was working on everything from artwork to high-end booze to baseball cards, you name it. So it was really, I think what happened in housing was more of this generalized asset inflation environment. And you can see that because even as prices have been very strong in many markets, you look at the absolute level of home sales, it's nowhere near what we had in this country at the peak of the bubble. In home ownership rates have gone up, but they're really kind of in the same range they were in the mid 1990s. So I think you've seen the select few, or the smaller group of people that can afford a house at inflated values and can qualify for a mortgage and so on, are experiencing generalized asset inflation. They've done great, but you have a lot of people, especially in sort of the millennial or Gen Z bracket, that they're sitting here staring at, they're in apartments staring at the value of houses and saying, how the heck am I ever going to get into one of these, especially given some of the overhangs and things like student debt and so on. So
is there hope for them? Can prices, if we end up with risk off and the economy heading into recession in a few years, could those values decline just as fast as they went up?
I definitely think we're going to see values stabilizing and declining in some markets, especially the highest end ones. And you're already seeing some evidence in places like New York City and so on, even before the COVID news, where you've seen supply going up, you've seen asking prices start to come down. Nothing like what we saw in 2007, 2008 to that degree, but it is stalling out in many of these markets. And I would argue you'd see the same thing in places like the greater San Francisco area. I mean, some of the appreciation there. I remember giving a presentation in 2018 and looking at some local real estate statistics for the Bay Area, and I think I computed that they were going up about $524 an hour or something like, or excuse me, it was an hour, and then that worked out to a wage. You could basically sit on your couch playing Xbox and eating Cheetos and make more on your home than you would if you were actually doing something. It worked out to something like $16 or $17 an hour. So that kind of appreciation just isn't sustainable, and I think that's what we're seeing now, where you're kind of hitting a wall in some of these markets, again, especially at the higher end.
Okay, and do you think that the great money panic could happen?
I think that we've already had a taste of it in again, not necessarily government bond market, but more the high yield and even investment grade market to some degree, as a result of what companies did pre-COVID. I mean, let's be honest. If you look at the last cycle, where were most of the debt excesses? Where was the greatest debt growth? Where was the biggest risk taking, and so on? It was in mortgages last time. This time, it's absolutely on the corporate side of the ledger. I mean, we talk about CLOs and all the junk paper that's kind of crammed into them, and takeovers at wildly inflated ratios funded by junk debt and the private equity boom and so on, and whether it's financial engineering by other companies borrowing to buy back shares and so on. That's where the excesses were in this cycle. So I think you're going to have an issue. I mean, the Fed, and again, the Fed has stabilized or given, the junk market a leg up and investment grade a leg up or so, just by intervening for the first time there in its history.
But I heard they didn't spend a dollar. It was all jawboning that rallied the market. Is that correct?
Yeah, almost all of it is. If you look at they did purchase some, I forget the exact total, but in terms of hundreds of millions or a couple $1 billion worth of ETFs and so on, but they haven't, mostly, the impact in prices and spreads relative to the actual dollars spent or used to this point, it's been a lot of bang for very little buck. But I think that, again, if the economic data is starting to roll over, we're getting a taste of that now. If that gets worse, the Fed's going to have to be in there a lot more aggressively than they have yet. People will play along, tag along, whatever you want to call it, ride the Fed's coattails. But if the cash flow issues are behind the scenes are bad and they start to get worse, you're going to see all of this roll over. And you're starting to get a taste of that if you look at some of the most economically sensitive sectors that benefited from the initial run-up. I mean, this is JETS. This is the ETF that tracks all the airlines. Big run-up from 12 to 22 bucks. Now it's back at 16 and a half. Cruise line, same story. So you're seeing some of that initial euphoria way off, or sort of run out a little bit, and now we're at a crossroads. And I think that's going to be really interesting for the next couple of weeks to see where things go here.
Okay, I just want to circle back to one statement you made, is that things could get away from the Fed. What should we be looking for to see if that's starting to manifest?
I think you're gonna see it. I mean, if you want, most people, if they want to just keep it simple, they can track things like this. This is the JNK, the high yield ETF, HYG,
Okay.
either of those. If you want to get a little more, a little deeper, you can go to sites like the FRED website, the St. Louis Fed website, and look at actual spread indexes, credit spreads, and see how they're behaving. Are they starting to widen out again? I mean, and we are seeing that, but it's been tentative. If we start seeing credit spreads begin to blow out and move in bigger chunks, that's when we're going to have some issues. And I think that I would keep a close eye on that. I would keep an eye on a lot of those economically sensitive sectors. Again, whether it's financials, I mean, this is the XLF. You can see it had a reversal yesterday, but then after the close, we got this news from the Fed about tying banks' hands when it comes to dividends and share buybacks because they're afraid of losses. I mean, that if you start to lose sectors like that, and we get into a situation where those are rolling over, then you've got problems, in my opinion.
Or how about just going to weissratings.com to get all this information? And, now would be a good time to show your website. And the best way for people to follow you on Twitter is at Real Mike Larson. And perhaps, do you have subscriptions for your service here? And it looks like you have webinars and everything. Why don't you tell us a little bit about what
sure.
you do? Sure. Do you service retail or strictly institutional?
No, we have a couple of different business lines, and we're in Weiss Ratings. Historically, the company has been involved in bank and insurance company safety ratings, so underlying solvency issues and so on, rating them just like a larger company like S&P would, for example. But it's tailored towards a mix of individual and institutional. Then many years ago, we also got into the investment rating side of the business, where it's a different ratings model that's designed to look at the quality of stocks, ETFs, mutual funds, and so on from an investment standpoint versus rating the underlying quality of the bank's balance sheets and so on. So we do both of those. And then we also have things like newsletters and more active trading services. I'm involved with the Safe Money Report. That's our longest standing product that Martin
actually remember it.
Yeah, Martin began it in the 1970s. I still have the first issue of what was then called Money and Markets. It's nicely yellowed now, but the little booklet it came with. But we've been doing the Safe Money Report for many, many years, and that's what I'm involved with. And so that's more of an investment, retail-oriented type product. But the ratings can be used by, again, an individual or institutional angle. And what people can do, it's very simple, just from the ratings website. They want to check the underlying fundamental ratings on their stocks, for example. You type in the ticker, you can get a brief report on Johnson & Johnson or what have you, and go from there.
Wow. Okay, so, everyone, here's a great resource for interest rates and bonds and all things related to it. And Mike, I want to thank you so much for, after a long week, having some juice left in your battery to come in here and talk to us. I learned some things from you today. So again, thank you, buddy, for coming here and edifying our community and F.A.C.E today, Mike.
Great. It was a great opportunity, and I appreciate you inviting me.
We're going to do it again, Mike. I'll be in touch with you on Twitter, and have a great weekend. I hope you and your family remain untouched, and I really do appreciate that you came here today, and would like to have you back. Well, what's nice about this interview is I could ask you anything, and you were already ready for it. So appreciate talking to a pro.
You got it. Thank you, Dale. Take care.
All right, Mike. Okay, everyone, that's a wrap. Remember, don't just count your pips, count your blessings. Have a great weekend, everyone. And we'll see you on Monday. Adios. You're very welcome, everyone. Thanks again, Mike.
Thank you.